Have you ever been confused about the differences between whole life and term insurance? Well, congratulations, you're in the right place. By the end of this video, I will explain the differences and the similarities between term life and whole life insurance and when it's appropriate to use both. I'm Benita Starkey, founder of Keystar Insurance. And I help go-getters and entrepreneurs find the best insurance policies to assist them with their needs. For the best insurance advice, subscribe to my YouTube channel, and I'll teach you all about life. The concept of life insurance was developed in 1760 by Presbyterian ministers. It was designed as a social program to help widows and children who were suffering financially from the loss of the primary breadwinner. As time evolved, these policies were developed by insurance companies to be purchased by individuals for their families, which would give them a peace of mind if something were to happen to them, their family could continue to live. They would not have to sell the home and downgrade their lifestyle. The death benefit is the sum of money that is left behind for the beneficiary. The base of all insurance is the death benefit. Term life insurance is also known as temporary insurance. As its name suggests, it provides coverage for a temporary term of time. Coverage is generally purchased as a 10-year, 20-year, or a 30-year term policy. The available term policy ranges depends on the company that the policy is being purchased from. These policies are most famous for having high face amounts and low premiums. Policies terminate in one of two ways. A, the insured dies before the end of the 10, 20, or 30-year period. Then the death benefit is paid to the beneficiary. Or B, the insured outlives the policy. Coverage is terminated, the death benefit evaporates, and the insured is left looking for another insurance policy. Nowadays, some insurance companies will offer an extension depending on the age that the insured is at the expiration of the policy. A 50-year-old may be able to secure a 20 or 30-year extension depending on the condition that they're in, at a much higher premium, of course. Policies are good to provide assurance that goals with clear completion dates are achieved. For example, an individual with children may purchase a 20-year term or a 25-year term to ensure that if something were to happen to them, that they wouldn't be denied the opportunity to go on to a college education. Another very popular use of term insurance is for individuals who are just purchasing property. Let's say that someone purchases a $200,000 house and they receive a 30-year mortgage to pay off the house. At the same time, this individual would purchase a $200,000 30-year term policy. Term policies used in this fashion are very often referred to as mortgage protector policies because they're used to do just that, protect the mortgage. Once the sale is finalized, the balance on the mortgage reduces with every payment that the insured makes. Even though it may not seem like it, it is reducing. In the same fashion, the available coverage time is reducing year after year after year after year on the term policy. Before you know it, 30 years will have passed, the house will be paid off, and the clock stops ticking on the term policy. Whole life insurance. Whole life insurance guarantees a death benefit to be paid out to the beneficiary when the insured passes. It is referred to as permanent insurance because coverage, unlike term, does not expire. Coverage ends when the insured passes away, not if the insured passes. It is most noted for its cash value, which is a forced savings account that is built within whole life policies. This pot of cash, if you will, builds and grows tax-free over the life of the policy. It is available for individuals to borrow against if a need should come up. For example, a down payment for a car, or a wedding, or to start a business. Just like a 401k, a person can go into their policy and take out a loan. Withdrawals are tax-free. The guaranteed accumulation of cash value and the tax-free withdrawals makes it an excellent vehicle for infinite banking. The younger an individual is when this policy is purchased, the lower the premium will be. So it is best that the policy, of course, is purchased as young as possible. That goes for all policies. However, with the whole life policies, the premiums are level. Therefore, if someone purchases a policy for a 2-year-old and the policy is $200 or $300 a year, I'm just throwing that out there. But when that individual is 75 years old, regardless of what has happened to him or her, their policy will still be that $200 or $300 for the year. The newest addition to the whole life family is living benefits. Living benefits is when a sum of money is available for the insured in the event that the insured should become critically ill, chronically ill, or terminally ill. It can be used to pay for therapy, short-term care, or other expenses. My best advice for policy seekers is to resist the temptation to run the large face amounts offered by term insurance policies. Remember, those policies are designed to provide a peace of mind. It allows the insured to rest knowing that if something happens to him, that his family's goals will be completed. On the other hand, if you want to leave a guaranteed death benefit for your family, you don't want burial costs to be a burden on your loved ones, and/or you're looking for a safe vehicle for tax-free cash value growth with tax-free withdrawals, then perhaps whole life may be the answer for you. In search of a life insurance policy and can use help finding the right policy for your needs? Click the link to apply to become my client. If you like this video, give it a thumbs up. Share it with a friend. And remember, you can have the perfect life.